Hi everyone, I'm Shelby Sawyer, Development Officer from Heartlinks Hospice and Palliative Care. We're here today to talk about a topic that's super important but often overwhelming to many, planned giving. To simplify things, I've invited Todd Halterman, planned giving expert, to join me. Welcome, Todd.
Hi, Shelby. I'm excited to be here to share information with people about giving to amazing nonprofits like Heartlinks.
Well, let's dive right in. Todd, planned giving sounds complicated. Can you break it down for us?
You know, it does sound complicated, but the reality is we share with everyone the question of how do you want to be remembered? We really want to help families plan out how to give, but give the IRS's portion so their family can inherit more, and that's what we're going to teach today.
So it's not just about writing a check?
No, it's exactly correct. It's really about thinking things through long term. But if I could teach donors how to disinherit the IRS with their business and financial plan and be remembered for their values and legacy and not just their money, isn't that what they want?
Disinherit the IRS. I think you've got everyone's attention now. How does that work?
Well, yes, less to the IRS seems to make sense. But if you put the word the and IRS together, it spells theirs. But they can't make a plan to disinherit the IRS unless they have charitable intent. And in fact, if you'll commit some time, you can actually leave more inheritance to your family.
Can you give us a brief example with some numbers that might help people further understand how that looks?
Yes, in simple terms, really what you're looking at, Shelby, is the opportunity for people with like a $500,000 401k account or IRA. If they hand that $500,000 to two children, what's going to happen is they're each going to end up with about $185,000 less. That's about a 37% drop because taxes are in there. But if you take $500,000, nobody ever estimates that a third of their IRA is going to go to the tax person that collects that tax. What we want to do is build a plan for them so the family can receive more than 100% of that gift, and the IRS will get significantly amount less. We have to agree to leave at least 10% to charitable interest to qualify for the tax deduction so we can give 130% of the IRA to your heirs. So your family literally can inherit, instead of $500,000, they can inherit up to 130% of that $500,000. But we have to elect to leave some to a charity. What we should look at doing is each child will basically have a trust in their name so that when Mary dies, the IRA proceeds will go into that trust. That trust is held in for their benefit, and money is paid out to them each and every year for over 20 years, or it can even be over their lifetime. But the goal is to make sure that the family inherits over 130% of what the 401k or IRA was when we make the gift. Now, because they're receiving that gift in installments, we want them to receive more income. But when the gift is done going to the children, whatever is left will remain behind to help the charity do their great work. And in your case, in the hospice and palliative care setting, it's take care of people who really need it.
That's great. So my kids can inherit 130% of my IRA account. But what if I don't have an IRA?
You're exactly right, Shelby, 130%. But here's reality. The IRS wants a piece of everybody's estate. So we want your families that you teach to be able to understand how to use that IRA effectively. But if they don't have an IRA, then something like highly appreciated stock, maybe it's NVIDIA or Apple or somebody's owned stock for a long time. But if they have assets that are highly taxable, we can do the same thing and help the family inherit more money than what is actually even in the stock or in the house or in the business, and leave a wonderful gift to awesome charities like Heartlinks. But we don't have to give your family less. They truly can inherit more.
Okay, so let's say that I have $100,000 in appreciated stock. What happens then?
It depends on if you want to utilize that gift while you're alive or when you're gone. But while you're alive, we can set that stock in an account and immediately sell it and not pay any taxes on the gain. Immediately be able to diversify that stock from one stock to several. And that donor, while they're alive, could get income from that stock for the rest of their life or a period of time that they elect. The simple fact is they put that in an account and it doesn't end up having tax against it because you are able to hold it and take income from it for as long as you would like. So the second part of that story is if Mary happens to pass away before she gives that stock to a charitable intent, then it'll either get a step up in basis or it will be given to the children in the same way as the IRA, where it's put in an account and it's sent to their children over a period of installments. Those installments end up being more than 130% of what the gift was in the first place. And then whatever remains in the account after the kids have received all of their inheritance, the charity will keep.
I don't understand why more people aren't doing this.
But here's reality. Our lives are busy and we spend time counting our money and worrying about how we're going to live on it. To talk about what we're going to do when we die is a subject that doesn't come up every day while you're drinking your coffee. So what we really try to do is break it down in sound bites to help families understand that they literally can give more to their family and less to the IRS if they just commit a little bit of time to doing some planning for planned giving. And they can find giving their family over 130% of their inheritance and leaving an indelible footprint to ripple for decades, to be remembered for their values and legacy. And it's simple. If you're willing to give just 10% of an account, we can help you disinherit the IRS.
Is now a good time to be thinking about this, Todd? The year end and making a planned gift?
This is a perfect time to talk about it because there are many donors at year end who are looking for tax deductions and want to know how to use that tax deduction, whether it's a highly appreciated stock that they want to diversify, or it might be something as simple as someone who's getting an RMD from their IRA and they don't use it and they're frustrated because it just increases their taxes. So we help people at year end look at their IRA account, and if you're not using your RMD, maybe they can give that IRA away, that IRA RMD away as a qualified charitable distribution, and it won't even show up on their tax return, but it counts as their RMD, so they can keep their money in their checkbook that they have already paid taxes on.
So we're at year end. What if I'm not ready to set up a whole planned giving outline? Is there something else that I can do right now?
There's simple strategies to be able to help people sell highly appreciated stock and not pay any taxes when they sell it. We just have to do some planning. Or if you're an IRA person who's required to take money out every year, we can show those people how to not pay taxes on their RMD and give that to a charitable organization like Heartlinks so that it counts, but they don't pay any taxes on it. Therefore, they'll lower their taxes on their tax return.
So wait a second. You're telling me that there are taxes that people are paying at year-end giving that they could avoid?
Yes. In fact, if anybody out there that's 70 and a half or older and they are now required to take money out of their IRA, the government changed the rules in 2020 and 2022 that allows us to be able to donate our IRA required minimum distributions that they're forced to take out. And when they do that, if they decide to give it to a charity instead, then it never gets taxed. So if we give away our IRA required minimum distributions and not write checks, the IRS doesn't get a dime of that money.
A gift like this would be phenomenal for Heartlinks and frankly life-changing for the programs that we offer. We're a nonprofit, Todd. We don't send a bill to our patients. This is huge for us.
Shelby, that's exactly correct. And planned giving is simply a process that we follow to make sure that Heartlinks and organizations like you that do great work in our communities get monies that would otherwise go to the IRS and truly help families inherit more, be remembered for their values and legacy so that someday their name is remembered in a way that's synonymous with true servant, true giving, and their children will see this gift as well and probably follow suit.
Todd, this has been super helpful. I've learned a lot, and I hope that you all have too. Thank you so much for being here.
I was glad to be here. And if you in America are who we are talking to today, just understand that in 3 simple, short steps with less than an hour of time, you can truly learn how much you can leave for your family more than what you thought, and leave a footprint behind to remember you for your values and legacy.